Thank you for the invitation to join you here today. It's a pleasure to be back here in Rochester. I was here 3 years ago, and it's a real pleasure to be back. I'll begin my speech with some basics about the Federal Reserve System and the Federal Open Market Committee, the FOMC. But the bulk of my remarks should be viewed as a quarterly report of sorts. Your elected representatives, the Congress of the United States, have charged the Federal Reserve with achieving key macroeconomic goals. My speech will be a report to you, the people of Rochester, about how the FOMC is doing in terms of achieving those goals. Now, please keep in mind, though, that I will be expressing my own views, and they're not necessarily those of others in the Federal Reserve System. And unfortunately, contrary to what Justin was saying, I'm not speaking for the government. I can only express my own views about today. So I look forward to responding to and learning from your questions at the conclusion of my remarks. As Jerry mentioned, there will be ample time for questions at the end. So let me begin with some basics about the Federal Reserve System. I like to tell people that the Fed is a uniquely American institution. So what do I mean when I say that? Well, relative to its counterparts, other central banks around the world, the U.S. central bank, the Fed, is highly decentralized. The Federal Reserve Bank of Minneapolis is one of 12 regional reserve banks that, along with the Board of Governors in Washington, D.C., make up the Federal Reserve System. Our bank represents the 9th of the 12 districts. And our district includes the state of Montana, both the Dakotas, Minnesota, the northwestern part of Wisconsin, and the Upper Peninsula of Michigan. So 8 times per year, the FOMC meets to set the path of interest rates over the next 6 to 7 weeks. All 12 presidents of the various regional Federal Reserve banks, including me, and the governors of the Federal Reserve Board contribute to these deliberations. But the committee itself consists only of the governors, the president of the Federal Reserve Bank of New York, and a rotating group of 4 other presidents. And I'm one of those 4 presidents this year. So in this way, the structure of the FOMC is designed to mirror the federal structure of our government, because representatives from different regions of the country, the various presidents, have input into FOMC deliberations. Now, this basic structure has a long history. In fact, this year, 2014, is the centennial of the opening of the 12 reserve banks and the start of the work undertaken by the Federal Reserve System. It's been a fascinating 100 years with many twists and turns along the way. And I'm sure that many of you have questions about that journey. For example, many of you are probably thinking, why the heck did Minneapolis get chosen as the headquarters of the 9th District as opposed to, say, Rochester? The answer to that question is pretty interesting. But in any event, the answers to all of your questions, and probably more, are on a new website that the Fed has created at federalreservehistory.org. So Federal Reserve History is all one word, no spaces, .org. And I encourage you to visit this site to learn more about the people, places, and events that have shaped Federal Reserve history. Now, I'm not going to say too much more today about Fed history, and that might be to the relief of some of you, but I do want to address one of the things that I think has changed the most over the Fed's history. That's our communication with the public. So 100 years ago, Congress created a system that was designed specifically so that the residents of Main Street would have a voice in monetary policy. So this 12-bank system I'm describing goes back to the originations of the system back in 1914. Now, technology has changed a lot since 1914. I'm told that this is my joke to attempt that I'm actually younger than I am. I'm told they didn't even have smartphones back then. That's my attempt to pretend that I don't know what a rotary phone is, but of course. And so the ways that we gather information from Main Street have changed as well with technology. But this fact-finding is still an important part of the making of monetary policy. Indeed, earlier today, I met with Southern Minnesota business leaders to gather exactly this kind of information. But communication is a two-way street. During the past century, the Federal Reserve's communications to the public about its monetary policy actions have also evolved greatly. And the pace of change was especially rapid in the past 8 years under Chairman Bernanke's leadership. During that time, the Federal Reserve established an explicit target for inflation, began holding regular press conferences, and greatly expanded its use of forward guidance, that is its communication about the likely evolution of policy. Now, as the Federal Reserve System plans for its second century, I would say the importance of two-way communication is a key lesson from our first century. In order for the Fed to continue to be effective, it needs to communicate its policy decisions transparently to the public. Conversely, it also needs the public's input on how those policies are affecting them. Events like the one today, and my meeting with business leaders earlier today, are a key part of fostering that two-way communication. So with that background in mind, let me turn back to the FOMC and the making of monetary policy. So I mentioned the FOMC meets 8 times per year. At those meetings, we decide on the level of monetary stimulus for the economy. Now, I'm not going to get into too many details in my speech about what the term monetary policy means, monetary stimulus, means. Although I'm more than happy to take questions about that later. For now, I'm just going to make 3 very high-level points. First, when the FOMC changes the level of stimulus, our actions tend to push inflation, that is the rate of growth of prices, and employment in the same direction. So if we raise the level of stimulus, that puts upward pressure on both inflation and employment. Lowering the level of stimulus puts downward pressure on both inflation and employment. So that's the first point, that we tend to move prices and employment in the same direction. The second point is the FOMC's actions only affect inflation and employment with a lag, usually thought to be 1.5 to 2 years or so. Finally, over the long run, monetary policy is the prime determinant of the overall rate of inflation in the economy, but many factors beyond monetary policy affect the level of employment. So that's what we do when we meet is we're talking about what the appropriate level of monetary stimulus for the economy is. But what are we trying to achieve? What is it the FOMC is seeking to achieve by varying the level of monetary stimulus at its meetings? So Congress has charged the FOMC with making monetary policy to do 2 things: to promote price stability and to promote maximum employment. And that first goal, promoting price stability, has been given, the FOMC has given it a specific definition, that is to keep inflation close to 2%. And the FOMC's job is to vary monetary stimulus over time then to meet these mandated objectives, promoting maximum employment and keeping inflation close to 2%. So now the remainder of my speech will take the form of a report to you about how the FOMC is doing in terms of meeting these goals that are set for us by your elected representatives in Congress. So I'll start with price stability. So again, operationally, the FOMC has translated the words price stability into keeping the rate of increase of the price level, that is the inflation rate, close to 2%. Now, even more specifically, the FOMC uses what's called Personal Consumption Expenditure Price Index, or PCE, to calculate inflation, which is slightly different from what you usually hear, the Consumer Price Index, CPI. We use what's called PCE instead. We think it gives us a broader a picture of what's going on with prices in the economy. The one thing I do want to emphasize is this measure of inflation that I'm talking about, the PCE inflation rate, captures the rate of increase in all goods and services, including those related to food and energy. So the Great Recession, now over 6 years ago, started in December, as data is starting in December of 2007. Now here's a graph of how PCE inflation has behaved since that date. And I made a point of emphasizing that this rate of inflation includes both food and energy, goods and services related to food and energy. And I think the fact that that's being included in that it shows up in huge variability. So if you look at the gray shaded area, that is the Great Recession. It starts in late 2007 and goes through the middle of 2009. in the first part of the Great Recession, inflation shoots up dramatically. And you might have been tempted in mid-2008, which is what that peak is, to be thinking, wow, inflation's running really hot. It's going to be hot going forward as well. But of course, what happened is it collapses. That's all being driven, a large amount of it, I shouldn't say all, but a large amount of that is being driven by oil prices, showing up then in gas. Okay? So this is why if you're trying to forecast where inflation is going to go in the future, people tend to strip out food and energy goods because of that variability and the short time, the temporariness, the transience of the shocks that hit. Any event, if you look over the longer term, which I think is the right way to be thinking about this, that the dotted line is showing the average of inflation rate, averaging through all the wiggles that you see since December 2007. And the average inflation has been 1.5%. Okay? So that's below the FOMC target. Moreover, what we see over the past really 2 years, and going back maybe a little bit further, but certainly over the past 2 years, we see a downward drift in the inflation rate. Currently, the PCE inflation rate is actually running near 1%, as opposed to the FOMC's target of 2%. So if you go back over the past 6+ years to December 2007, inflation has been running too low to be consistent with our definition of price stability. Now, what you can't see in the graph is the future. And that's what, when we make monetary policy, we're trying to look ahead to see where things are going to be going. The good news is that the FOMC does expect inflation to turn back toward 2%. However, I expect that return to 2% to take a long time, probably in the order of 4 years. And I'm not the only one who's forecasting that kind of slow return to 2% inflation. Earlier this year, the Congressional Budget Office, which is predicted that the inflation rate will not reach 2% until 2019. So that's 5 years from now. So I think a one-sentence summary of this graph is that the FOMC is undershooting its price stability goal. Whether you look backward in time or forward in time, we're undershooting our price stability goal. Okay, so that's the first thing I want to talk about is how we're doing in terms of price stability. But let me take a little bit of a detour for a second, or more than a second, and talk about why it matters that we're undershooting our price stability goal. Why should you care that inflation is too low? It seems like it should be a good thing when goods and services aren't as expensive to buy. And that's what low inflation means. And this is a very good question. And the reason you should care is because below target inflation signals a significant problem in our economy. So let me explain what I mean by that. At a basic level, you should think about prices as a signal about how well our economy is using its available resources. So in 2012, I had an experience that brought home this intuition in a very clear way. So I visited Williston, North Dakota. So Williston, for those who don't know, is in the western edge of North Dakota. Now, just as it's true today, when I visited Williston, it was in the heart of a major oil boom. And that boom was pushing hard on physical resources, like roads, water, housing, available to Williston, and pushing hard on the human resources available to Williston. The result of that push from demand on available resources was relatively high inflation. So that's a sign. When inflation is high compared to the Fed's target, like it was in Williston, we know that demand is pushing hard on available resources. And the converse is also true. When inflation is low, as this picture is showing, compared to the Fed's target, that's a signal that demand for goods and services is too low to fully use the available resources in society. This low inflation in the United States tells us that resources are being wasted. Now, what exactly are these wasted resources? There are multiple answers to this question. When demand is too low, lots of resources end up being unused. But the biggest and most disturbing answer to this question of what is being left underutilized is, in fact, our fellow Americans. There are many productive people in the United States who are available to work more hours, and our society is being deprived of their production because demand is too low. And I think this key point is generally underappreciated. I've said that the FOMC is undershooting its price stability objective and is expected to continue to do so. But we should all keep in mind what this means. It means that this outcome and the forecast for continued undershooting, it typically means that the FOMC is also underperforming on its other objective of promoting maximum employment. Okay, so that's a little abstract. I've argued that the low inflation rate is a signal that the FOMC is underperforming with respect to its maximum employment objective. But you don't need to rely on this relatively abstract signal to reach this conclusion. We can readily see this underperformance in numerous key metrics of labor market performance. So I'll begin by showing you data on the evolution of the unemployment rate. So in March of 2007, so again, this takes you back a longer history than what you saw with the inflation rate. But again, the gray shaded bars represent recessions, and the most recent one is the Great Recession that started in December 2007. And as we headed in right before the Great Recession, the unemployment rate, this is back March of 2007, we go back 7 years now, the unemployment rate was 4.4%. It rose slowly through out 2007 to reach 5% by the end of the year. And then as the recession takes hold, see unemployment shooting upwards. And it peaks in October 2009 at 10%. Now, since that date, over 4 years ago, the unemployment rate has fallen slowly to 6.7%. You can see that where we are now, the current bar here is 6.7%. But you look back historically, that's pretty still relatively high, right? Most of the time we're below 6.7%. There's a recovery from the recession in the early 80s, and then we have a time period in the early 90s when we're running above 7% in terms of unemployment. I would say that basically this picture shows you that an unemployment rate of 6.7% means that the U.S. labor market is far from healthy. I would say that this measure, though, troubling as it is, the fact the unemployment rate is still 6.7%, that actually still, I would say, could be an overstatement of the degree of improvement that we've seen in the U.S. labor market. So when you think about the unemployment rate, the Census Bureau asks, to calculate it, the Census Bureau asks people two questions. Are you working? And if not, have you looked for work in the past 4 weeks? The unemployment rate measures the ratio of the second number, the people who have looked for work in the past 4 weeks, to the sum of the two numbers, the recent job searchers and the workers. So this means that the unemployment rate could actually decline for two reasons. Because more people are finding work, because fewer people are looking for work. Most of the declines in the unemployment rate since October 2009 have occurred because the fraction of people who are looking for work has fallen. And a way to see this is by looking at what's called the employment to population ratio. It's the fraction of people who are over the age of 16 who have a job. Now, if you go back to March of 2007, so this is now the employment population ratio, and if you go back to March of 2007, it peaks before the recession at just over 63%, and fell sharply during the Great Recession and bottomed out at around 58%. We've seen a little bit of a comeback, especially the last few months have been good, but still well below where we were. The percentage has risen little from the low point and remains lower than any time between 1986 and 2007. Now, we have to be a little bit cautious here. The employment to population ratio is being shaped by demographic forces. And these demographic forces would have led to some decline in the employment population ratio, even without the Great Recession. So what do I mean by demographic forces? Well, the baby boom birth cohort was born between 1946 and 1964. As that cohort ages, the fraction of retirees in the population grows steadily. So that's just the natural retirement process for people in the economy. But these demographic forces are still not large enough to account for most of the decline in the employment to population ratio that I've described. So one way to see this is to look at people who are outside the normal retirement age, people who are aged 25 to 54. And here I plotted the fraction of people who are in that age group who have a job. And again, you see that sharp fall during the recession. Here, the good news is we definitely see more of a recovery from the bottom. And you can see how those demographic forces are affecting the broader measure. And so we see more of a comeback from the nadir just after the Great Recession. But it still remains lower than any time between 1986 and 2007. So this is among, as I said, people aged 25 to 54, sometimes referred to as prime age, working age. Now, even if you look among those who have a job, there are signs that where the economy is significantly underemploying our human resources. The Bureau of Labor Statistics reports each month on the number of Americans who are working part-time and who would like to work more hours but are unable to obtain those additional hours. That fraction of the labor force has fallen, but it remains unusually high. And so this is a picture of that. This doesn't go back, as we don't have measures of this going back as far. So it only goes back to the early 90s. But what we see, again, huge spike in the behavior of this series at the time of the recession. It really doubles from 3 to 6%. It's come back down, very positive, but still see it highly elevated. So these are, again, are people who are working part-time but are unable to find extra hours. So what do we learn from all these charts? I think good news is that the labor market has improved since the end of the Great Recession. But the bad news is the rate of improvement over the past 4+ years has been painfully slow. And as a consequence, there is still significant underutilization of our country's most important resource, its people. So we have to conclude, I think, that the FOMC is underperforming with respect to its goal of promoting maximum employment. So let me conclude before taking questions. Earlier, I asked you to consider this speech as a report to you, the people of Rochester, on the FOMC's performance with respect to its 2 congressionally mandated objectives. We've seen that the FOMC is undershooting its price stability objective, and that inflation is running well below the FOMC's goal of 2%, and it's expected to remain that low for several years. This undershooting is problematic because it suggests that the American economy is wasting available resources, especially its human resources. We've seen strong evidence of this underutilization in the performance of key labor market metrics. So the FOMC is also underperforming with respect to its maximum employment objective. I think we need to do better as a committee, and I look forward to working with my colleagues to make that happen. Thank you for listening. I'd be happy to take your questions.